In this lesson, we're going to move into the next step of our LBO model, which is to create some of our operating assumptions that we're going to need to project Apple's income statement and cash flow statement. Now, you see up here under operating assumptions is that I've filled out, or rather repeated, linked in directly from much of the previous work that we did on Apple's 3 statements. To refresh your memory, let's just go back to the first page here. And I will go up. We see that under operating assumptions here, we made all these assumptions about revenue, cost of goods sold, operating expenses, other items on the income statement, balance sheets, and cash flow statements. And then we use those to actually go in and create our model, basing most of these assumptions on a percentage of revenue or a percentage of expenses or similar items like that. So what I've done here is I've linked in directly. And so rather than repeating these all over again, we're simply going to reuse the work that we did previously and apply these again in our LBO model. The main difference between these and the assumptions that we created on our 3-statement model right here is that we have all these balance sheet assumptions on the 3-statement model assumptions here. So accounts receivable, accounts payable, deferred revenue, and so on. We're going to skip over all of those because in our basic LBO model, we're not going to be projecting or even using Apple's balance sheet. It's not absolutely required in an LBO model. You can take a shortcut, as we will be doing here. In the more advanced LBO model, we will be doing this. We'll be looking at the balance sheet and making all these assumptions there. But in this more basic version, we're going to skip over balance sheet projections because they're not absolutely necessary. So what I've done instead of making all those assumptions, I just have this single line item for change in working capital as a percent of revenue. And if you look at the formula here and go back and trace this with control left bracket, basically what I'm doing here is I'm just summing up all the changes in operating assets and liabilities right here on the cash flow statement. And I'm making them a percent of revenue at the top on the income statement. And so rather than projecting the full balance sheet for Apple, we're simply going to take a shortcut and use these assumptions for changes in operating assets and liabilities instead. Other than that, everything is just being linked in directly here from our operating assumptions, so there's not too much to say on most of this. We're going to be using the same exact numbers because we don't want to be going in and using different projections for an LBO model than we are in our merger model or in our valuation or anything else. We want to be consistent and use the same numbers, the same projections all the way across throughout our model here. One additional assumption we need to make here is a minimum cash balance. Now the reason this is important, and this is something that did not come up the first time around when we created our 3-statement model. If you recall, on our balance sheet, the cash was pretty much always going up by a good amount each year here. But the reason it's important is because in an LBO model, we have something else to consider, which is that with any type of bank debt, we have principal repayment, and for both bank debt and high yield debt, we have interest payments. And so what can often happen in an LBO is that the interest payments and the repayment of the principal may often use up your entire cash balance unless you're careful and you set up a minimum cash balance. It's sort of like how you may have credit cards, you may have loans, you may have assets that you can sell, and all this is fine, but you still always want to carry around some kind of cash in your wallet because you never know. Some place may not accept credit cards, you may not be able to get the cash quickly enough, you may not be able to take out a loan right at that moment, so you always need some kind of cash on hand to pay for random items that you come across. And in a similar way, a company always needs a minimum cash balance because it needs to pay employees, it needs to keep the lights on, to keep buildings running, all sorts of other activities like that. So a company is always going to need some kind of minimum cash balance. And with an LBO model, we have to be really careful because if we don't have this, then there's a possibility that we may run out of cash because of our interest payments on debt and because of our principal repayments of that debt. So to get a sense of this, I'm going to link into our initial cash balance over on our 3 statements over here. So we see initially cash is around 6.5 or 6.6 billion here. For the minimum cash balance, I'm going to keep it very close to this one, and I'm going to say 5 billion. For a company of Apple's size, this is a reasonable assumption. So if you think about it, they have revenue of around 45 billion. A minimum cash balance for a company that size of 5 billion is reasonable in this case. So with that in place, we're pretty much done with our operating assumptions. So what we want to do next is go to our income statement and actually make our projections here using our assumptions from above right here. Now on the historical side, what I've done here is I've pretty much linked in directly from our three-statement model. For the historical side, that's okay because none of these numbers are going to be changing around. So I've linked in directly. In a few cases, such as for interest, income, and expense, I've done a sum formula here to simplify what we had before. But other than that, I'm really just linking indirectly. The problem though is that when you go to make the projections, you don't want to link directly to the income statement that we created before because we may have changes. So we may have more amortization, we may have more stock-based comp, we might have a higher interest expense number here, and so it gets dangerous to link in directly to our old projections. So what we want to do in this LBO model is actually create new projections for Apple's income statement. And so for your exercise, what I want you to do is to actually take our income statement right here, starting in 2009, and then go up to our assumptions right here and actually go in and fill out this income statement yourself. Now you're not going to be using all of this, so changes in working capital, CapEx as a percent of revenue, and then the effective cash interest rate, you're not going to have to worry about those for now, but everything else on there will be a part of our projections for Apple. So to get this started, for revenue, for example, what we do here is take the 2009 number and multiply by 1 plus the revenue growth rate right here. And then we could actually just copy that formula across. So what I want you to do now is to pause this video and then to give this a shot yourself with projecting all these numbers. Now if you get stuck or you get to a number where you don't know what to do, such as interest income for example, just leave that blank for now, but fill in everything you can. Then when you're done, you can unpause this video and I'll walk you through it and show you how to do everything here. So pause this video right now and try to project this income statement over these 5 years yourself. Okay, good. So here's what we do for our income statement. I started with revenue and linked it to the revenue growth rate. For cost of goods sold, I'm going to take revenue and then multiply it by COGS as a percent of revenue. Gross profit, I'm going to take revenue minus COGS. Research and development, I'm going to take revenue and then multiply it by R&D as a percent of revenue. SG&A, the same thing applies. Take revenue and multiply by SG&A as a percent of revenue. Total operating expenses, I'm going to sum these up with alt equals. These next items here, D&A, amortization, stock-based comp. So for depreciation, I'm going to go up. We see here that we've defined this to be a percent of revenue. So I'm going to take our revenue number and then multiply by D&A as a percent of revenue. Amortization of intangibles, this one is not a percentage. This one's actually an absolute number. So I'm going to go up to amortization of intangibles and link directly to that. Stock-based comp, once again, take revenue and multiply by stock-based compensation as a percent of revenue. Now for operating income, we're going to take gross profit minus operating expenses minus depreciation minus amortization minus stock-based comp. Interest income and expense, we're going to leave this one blank for now. We're going to have to come back to this once we calculate how much interest we're paying on debt each year and how much interest we're earning on cash each year. So we're going to come back to this one later on. So for pre-tax income for now, I'm just going to enter a sum formula here and say it's the sum of interest income plus operating income. For the income tax provision, I'm going to take pre-tax income and multiply by the effective tax rate of 30%. Net income, we're going to take pre-tax income and then subtract the income tax provision. Then finally for EBITDA, we're going to take operating income, add stock-based comp, add amortization, and then add depreciation. So we have all these numbers in place. And now to finish projecting these formulas all the way across, we can select everything with Shift Control down arrow key, Control C to copy it. I'll press Shift and then the right arrow key 1, 2, 3, 4, 5 times, and then Alt ESF to paste these formulas. And so now we have our projections for Apple going through 2014. Interest income is left blank for now, and some of the other items here we'll have to come back to later on, but the basic outline for our income statement is now in place. So we've now finished our operating assumptions and our income statement projections for Apple in this LBO model. As you can tell, it's very similar to what we did previously for the three-statement model, but we are making some of our own numbers and some of our own projections here because this will be a bit different in the context of an LBO. So coming up next, we're going to be looking at the next step of our process here, which is to project Apple's cash flow statement over these 5 years, figure out what is going on there, and some of the changes that we'll have to make to our existing cash flow statement to support an LBO model.